the real difference among whole, term, and universal life policies. Hi, I'm Sunny Mitra, founder of Bright Horizon Wealth. We teach entrepreneurs and go-getters like you how to own their financial future with the concept of infinite banking. So, make sure you subscribe to our YouTube channel and hit the notification bell so that you can be notified every Sunday and Thursday. We come out with brand new videos to learn how you can make more money by working smarter, not harder. Stay tuned to the end of the video and get a valuable tool today which will bring your financial freedom faster than anything else, I promise. So today's topic is the real difference among whole, term, and UL policies. For the sake of simplicity, we are going to divide our video into two sections. In the first section, I'll define in simple terms what is the meaning of term life, whole life, and universal life. And in section number 2, I'll go through the benefits and features and the differences between these three life insurance policies. So, term life. It pays a benefit in the event of the death of the insured during a specified term. Whole life. It provides coverage for the life of the insured while building cash value inside it. Universal life. It provides coverage for the life of the insured with a flexible premium option. Let me give you an example which will make it easier for you to understand the difference between these three and also remember it for a long time. There are basically two kinds of life insurance policies: temporary and permanent life. Term life insurance are for temporary coverage like 10, 20 or 30 years. For example, you bought a term life insurance for 15 years. Once that period is over, you do not have any more coverage. The reason people buy it basically because they are cheap. For a small amount of money, you can buy a lot of death benefit coverage. And it does not build any cash value because it does not have any savings component built inside it. So, for instance, you rent an apartment, live in there for 10 years, then you leave. During those 10 years, you kept on paying your landlord a rent each and every month in and month out. You paid him for 10 long years. And now, when you get out of that apartment, he does not owe you nothing. And that is exactly like buying a term life insurance policy. You have the coverage as long as you are paying them rent. Once you are out, it's done. All your money is gone. Now you have to start all over again. On the other hand, think about this scenario. You bought a house. You paid the mortgage to your bank for 10 long years. Now you have some equity build up in the house. And that is exactly like buying a whole life policy. As the time goes by, it builds cash value inside it. Just like if you have a 15 or 30-year mortgage. Once it's over, you own the house. Moreover, a whole life policy with the 4% guaranteed rate of interest for all these years, and also you have the possibility of getting a dividend check at the end of the year. Now, I think you have some basic idea about the difference between a term life and a permanent life. By the way, both whole life and universal life falls into the category of permanent life insurance. Let's put it like this. A whole life insurance offers consistent premiums and guaranteed cash value accumulation, while a universal life policy provides flexible premiums, death benefits, and a savings option. Now, a little more about universal life policies. In the 1980s, when universal life insurance was introduced, it became an overnight sensation. Simply because, as they said, it was a bridge between whole life and term life. In other words, it's a permanent life policy which goes for the rest of your life and also gives you some flexibility to pay your premiums. You can increase or decrease your premiums based on your good times or bad times. Now, if you browse through your computer, you will find a Wall Street Journal article published on September 19, 2018, which says universal life insurance, a 1980s sensation, has backfired. It continues, a long decline in interest rates caused premiums to soar when they were supposed to stay level. As the reporter named Leslie continues, a popular insurance product of the 1980s and 1990s has come back to bite many older Americans. Universal Life was a sensation when it premiered, and for some years it worked as advertised. It included both insurance and savings account that earns income to help pay future costs and keep the premium the same. But once the interest rates in the market went down, it caused the premiums for universal life insurance to soar, which created a problem for many older Americans. Unfortunately, these people had thought that they are buying a permanent life insurance policy with the flexibility of premium. One thing that was never mentioned to them was that premiums can go up based on the market fluctuation. And now, after paying the premium for 20, 30 or even 40 years, these people are out of luck. One of my 76-year-old clients told me recently, "Sonny, by buying this universal life policy, looks like I gambled with my life and my family. I bought it so many years ago, I paid them monthly premiums for several decades without fail, hoping it will build some cash value inside it, and also I'll have a life insurance coverage for the rest of my life. But now, due to this market fluctuation, I cannot afford to pay the premiums because they are so high. And when I called the insurance company, they said I did not have any cash inside it. I'm devastated and do not know what to do." And you know what? It is hurtful. If he would have bought a whole life policy with the 4% guaranteed interest for all these years and a possible yearly dividend check, what do you think it would value today? You do the math. For me, when it comes to money, primarily I go for two things: simplicity and guarantee. Just think for a moment why some people like their bank CDs so much more than any other investment. Do you think primarily because it's simple to understand? Because it does not have so many moving parts? Because it's not complicated as to understand market fluctuations, indexes and whatnot? And secondly, the reason they love it because it's guaranteed. If a bank CD promises you will pay you so much of interest, you are dead sure that you will get that interest at the end of the term. No ifs and buts. But the only problem with the bank CD is these days it is paying next to nothing, right? So what is the solution? A traditional whole life insurance policy with the concept of infinite banking. A whole life policy insures your life, so when you check out of your life, the money will check in to take care of your loved ones. I'll say it one more time. When you check out of your life, the money will check in to take care of your loved ones, and that is the death benefit. Infinite banking concept goes one step ahead and focuses more on your living benefits. We construct your policy the way that it accumulates more cash inside it than a traditional whole life policy. How? By focusing more on the cash value than the death component. And on the top of everything, you can have access to as much as 90% of your money from day one. Here's a quick story of one of my friends, how they were able to get rid of their $6,000 credit card debt that they owed a credit card which was charging them 29% interest. They bought a whole life policy and dumped $10,000 as their annual premium. Then they turned around and after 30 days took out $6,000 from their policy as a loan and paid off their credit card. Now they can sleep better. So to recap, A term life insurance policy just covers your life for a certain period of time. A whole life policy is for your whole life with a built-in cash value accumulation component. And a universal life is in between a term and a whole life policy. Now, I know what you must be thinking, Sunny, where is the bonus tip for the day? In my last video where I mentioned the word photo reading, some of my viewers asked me to throw some more light on it. So here is a brief description of photo reading. You all know or heard about speed reading, that you can read up to 3000 words per minute. But in photo reading, you can read up to 25,000 words per minute. How? Because you read it through your subconscious mind, which is how you can finish a 200 pages book in 10 to 15 minutes with 85% of comprehension. And the reason I mentioned about it is because the best way to make money is to become a student of finance. And through photo reading, you can read an enormous number of books in a year. Like they say, to earn more, you need to learn more. And what would be the best time to use this when we are all logged in inside our home due to coronavirus? Just Google it and you will find all the details about photo reading. So that's about it for today. Now I have a question for you. What is the one thing you got from this video today? Please let us know. Thank you for watching our video today. If you want to learn more about it, check out our free on-demand masterclass, which explains it in a more in-depth setting. Your comments are my oxygen. Please take a moment and say hi in the comment section and let me and my team know what you thought of the video. It would mean the world to me if you hit the subscribe button. Check out our next video on Sunday called Financial Security from Coronavirus, where we'll get some insights as to how to prevail amidst the coronavirus wave. And don't forget to own your financial future or someone else will.